It's June 30, 2025. Notifications flood the Robinhood app across Europe. Robinhood is offering tokenized shares of OpenAI and SpaceX to users in Europe. The platform is intuitive. Fractional shares from just $1, 24/5 trading hours, and near-instant settlements powered by the Arbitrum blockchain. No longer confined to waiting for IPOs or rubbing shoulders with venture capital elites, based on recent transactions, OpenAI and SpaceX are valued at $500 billion and $350 billion, respectively. This move sent its shares up nearly 13% to a new all-time high. Robinhood CEO Vlad Tenev champions this as a seismic shift during his recent earnings call and public appearances, emphasizing tokenization as the key to unlocking illiquid assets for everyday users. But amid the excitement, doubts emerge. Does this truly open the doors to private equity, or is it merely a sophisticated derivative product dressed in blockchain clothing? Since its 2013 debut, Robinhood has revolutionized retail investing with commission-free trading, amassing over 23 million funded accounts and becoming a go-to for millennials and Gen Z. By 2025, riding the wave of a thriving crypto market, the company has pivoted toward tokenization, targeting European users exclusively to navigate regulatory landscapes. This initiative fuses traditional equities with blockchain technology, aiming to enhance liquidity and accessibility for real-world assets, RWAs. Tokenization involves digitizing ownership rights into blockchain-based tokens, potentially transforming trillions in illiquid markets. However, for private giants like OpenAI and SpaceX, it introduces complexities around legal ownership, contractual obligations, and inherent risks that could render the model precarious or even unlawful. The catalyst struck in June 2025 when Robinhood finalized its $200 million acquisition of Bitstamp, a veteran crypto exchange, bolstering its European footprint. Days later, on June 30, the firm unveiled over 200 tokenized U.S. stocks and ETFs on Arbitrum, with OpenAI and SpaceX as flagship offerings, assets once reserved for accredited investors and VCs. Tenev, leveraging his physics background from Stanford, paints a vision of frictionless markets where assets flow like particles in a collider. The setup involves Robinhood's EU subsidiary collaborating with regulated custodians to manage underlying exposures, often through derivatives rather than direct holdings.
Including stock tokens, which I think tokenization is the biggest innovation in capital markets in over a decade. Stock tokens will do for stocks what stablecoin did for fiat currencies. Benefits to users including 24/7 trading, instant settlement, the power of
How it actually works. At its core, Robinhood isn't distributing genuine shares of these private companies. Instead, it issues stock tokens, synthetic derivatives created on the Arbitrum blockchain. When a user purchases a token, Robinhood establishes a derivative contract that mirrors the asset's value. A corresponding ERC20 token is then minted via smart contract, granting the user a claim on that derivative. Valuations are updated periodically using oracles or market data feeds from secondary markets, enabling 24/5 trading that bypasses traditional T+2 settlement times in favor of blockchain's near-instantaneous finality. For a private company like OpenAI, access stems from secondary market transactions or partnerships with cap table administrators, allowing fractional exposure, for example, 0.001% of a share's value. Trading happens in a controlled, walled garden. Tokens can only be transferred between KYC and AML-verified wallets, enforced by a smart contract registry. This design blocks integration with broader DeFi ecosystems, prioritizing compliance over full decentralization. Any dividends are distributed as tokenized equivalents, but users forfeit voting rights. These aren't true equity instruments. Delving deeper into the mechanics, Robinhood's EU terms label these as U.S. stock derivative contracts. Smart contracts on Arbitrum incorporate programmable logic for minting, burning, transfer restrictions, and value alignment. For example, if OpenAI announces a funding round boosting its valuation, the token's price adjusts accordingly. The underlying derivatives are custodied by Robinhood or partners like Bitstamp, not users. In disputes, EU law governs via arbitration, with Robinhood retaining discretion to delist tokens or recalibrate values during market events. A review of decompiled smart contracts reveals a whitelist of approved addresses, ensuring only verified users participate and curbing illicit activities. While commissions remain zero, users shoulder Arbitrum gas fees, and Robinhood profits from bid-ask spreads or tokenized asset lending. Crypto analyst on X, August 3, 2025. This is essentially a derivative wrapper, not genuine tokenization. No real DeFi interoperability, just Robinhood's siloed playground. As adoption grows, the fine print comes under fire. The centralized walled garden approach, while aiding regulatory adherence, introduces single points of failure. Robinhood's systems or Arbitrum's network could falter, leading to outages or depegs. Fees are low, but the model's reliance on oracles raise manipulation risks, echoing past crypto exploits. The drama escalated in early July when OpenAI and SpaceX publicly distanced themselves, stating the tokens lack endorsement and don't confer actual ownership. Robinhood countered that the tokens provide legitimate exposure via compliant vehicles, but lawsuits have already emerged alleging misleading representations. By August 2025, the spotlight intensifies as Tenev announces expansions into tokenized bonds, real estate, and more, aiming for 2,000 assets by year-end. Yet watchdogs strike back. The World Federation of Exchanges flags integrity risks from opaque marketing, while SEC inquiries revisit 2013 precedents on unregistered securities. In Europe, ESMA investigates potential MiFID II breaches on transparency and investor safeguards. Vulnerabilities like Oracle failures or custodian breaches could cause tokens to plummet, eroding trust. So, why the legal jeopardy? Under U.S. law, the Howey test could classify these tokens as securities if they involve investment contracts with profit expectations from third-party efforts, necessitating SEC registration, which Robinhood sidesteps via its EU focus. But cross-border flows invite enforcement. In the EU, if reclassified as financial instruments, stricter disclosures apply, potentially incurring hefty fines for lapses in protection. Safety concerns are equally pressing. Absent shareholder perks like voting or reliable dividends, often simulated, users are at Robinhood's mercy, subject to delistings or unilateral adjustments. Blockchain pitfalls include smart contract vulnerabilities, recall the DAO's 2016 hack, and Oracle inaccuracies leading to depegs. Centralized custody amplifies FTX-like collapse risks, where user assets could evaporate. The hype might also draw inexperienced retail investors into volatile privates, magnifying downturn losses. Detractors dub it as speculative financialization, favoring short-term liquidity over long-term stability. Robinhood's bold foray could catalyze a $16 to $30 trillion real-world asset market by 2030, with competitors like Coinbase and BlackRock eyeing similar plays. Yet it balances on a razor's edge. The fundamental problem is that private companies are private for a reason, and they have total control over their ownership. It's unlikely that they will compromise on things like information disclosure, which can be crucial for their competitive advantage and for investor protection purposes as well, unless tokenization of their equity provides enough incentives for them to comply. Still, it requires clear rules. As of late August 2025, regulators are circling with calls for clearer rules, possibly imposing bans, mandatory registrations, or enhanced transparency. For some investors, it's a tantalizing glimpse of empowerment, a future where private giants are within reach. But in the current tokenized realm, the platform holds the keys and reaps most benefit. Tokenization's promise is immense, but without robust guardrails, it risks unleashing more than just liquidity. This is actually my first video on YouTube. I want to thank you for watching.